Technical analysis. It sounds intimidating, doesn't it? Like a secret code only Wall Street wizards can crack. But let me tell you, it's not as complicated as it seems. In fact, anyone can learn the basics and start using them to make more informed trading decisions. Technical analysis is like reading the story of a stock or other asset. It's about looking at its past performance, its ups and downs, to get clues about where it might be headed in the future. We do this by studying charts and patterns. These tools help us identify trends and potential trading opportunities. Think of it like being a detective, but instead of solving crimes, we're solving the mysteries of the market. We use our magnifying glass, or in this case our charting software, to examine the evidence, connect the dots, and make educated guesses about what's going to happen next. Technical analysis won't give you a crystal ball, but it can be a powerful tool in your investing arsenal. It's all about understanding the language of the market and using it to your advantage. So, are you ready to embark on this exciting journey with me? Let's dive in. Charts are the heart and soul of technical analysis. They provide a visual representation of price movements over time, allowing us to spot trends and patterns that might not be obvious just by looking at numbers. Imagine trying to understand a story by reading a jumbled mess of words. That's what it's like trying to make sense of the market without charts. Charts bring order to the chaos, transforming raw data into a clear and concise narrative. There are various types of charts used in technical analysis, but the most common ones are line charts, bar charts, and candlestick charts. Each type presents the data differently, offering unique insights into price action. The choice of chart type depends on your personal preference and the kind of analysis you're conducting. But regardless of which one you choose, the goal remains the same: to identify trends and patterns that can help you make better trading decisions. Charts are like maps, and patterns are the landmarks that guide us. By learning to recognize these patterns, we can anticipate potential market movements and position ourselves accordingly. Some patterns suggest that the price is likely to go up. We call these bullish patterns. They're like green lights telling us it might be a good time to buy. Examples of bullish patterns include head and shoulders bottoms, double bottoms, and ascending triangles. Other patterns, called bearish patterns, suggest that the price might go down. These are like red lights, warning us to proceed with caution. Examples of bearish patterns include head and shoulders tops, double tops, and descending triangles. It's important to remember that patterns are not foolproof. The market is a dynamic beast, and not every pattern will play out as expected. But by learning to identify these formations, we can increase our odds of success and make more informed trading decisions. Section 4. Moving averages, smoothing out the price action. Moving averages are like noise-cancelling headphones for your charts. They help us filter out the daily fluctuations in price, allowing us to focus on the underlying trend. Imagine trying to have a conversation in a crowded room. It's hard to hear anything over all the noise, right? Moving averages are like finding a quiet corner where you can finally understand what the other person is saying. There are two main types of moving averages: simple moving averages, or SMAs, and exponential moving averages, or EMAs. SMAs give equal weight to all data points, while EMAs give more weight to recent data. Traders use moving averages for various purposes, such as identifying trend direction, spotting potential support and resistance levels, and generating buy and sell signals. By understanding how to use these tools effectively, we can gain a clearer perspective on the market and make more informed trading decisions. Section 5. RSI, measuring the strength of price movements. The Relative Strength Index, or RSI, is like a fuel gauge for a stock. It tells us how much buying or selling pressure is left in the tank. Imagine a car that's been driven hard for a long time. It's probably running low on fuel, right? The RSI helps us identify stocks that might be overbought, running too hot, or oversold, running out of steam. The RSI oscillates between 0 and 100. A reading above 70 is considered overbought, while a reading below 30 is considered oversold. These levels can act as potential warning signs, indicating that a trend might be due for a reversal. However, it's important to use the RSI in conjunction with other indicators and not rely on it solely. Sometimes a stock can remain overbought or oversold for extended periods, especially during strong trends. Section 6. MACD Identifying Momentum Shifts. The Moving Average Convergence Divergence, or MACD, is a versatile indicator that helps us identify changes in momentum. It's like a speedometer for the market, telling us whether the price is accelerating, decelerating, or cruising along. The MACD is calculated by subtracting the 26-period EMA from the 12-period EMA. The result is plotted as a line that oscillates around a zero line. A signal line, typically a 9-period EMA of the MACD line, is also plotted for trading signals. When the MACD line crosses above the signal line, it suggests that bullish momentum is increasing, which could be a buy signal. When the MACD line crosses below the signal line, it suggests that bearish momentum is increasing, which could be a sell signal. Like all indicators, the MACD should be used in conjunction with other tools and techniques for confirmation.